In this video, I'll be showing you what actually changes between $2 million and $3 million in retirement savings in Canada. Because while $3 million is obviously better than 2, the way that the extra million behaves inside the Canadian tax system is actually not all that intuitive. Through working with clients on both sides of this range, I've seen that once you get into kind of the $2 to $3 million zone, retirement outcomes stop being driven by how much you have saved, and they start being driven by how intentionally you draw it down. At that level, bad sequencing doesn't just cost a little bit more tax. It can quietly erase a shocking amount of value and leave you dying with a massive but avoidable tax bill. So that's exactly why I'm going to make this video here today, to walk you through a real Canadian retirement case study, show you where the money actually goes at $2 million versus $3 million, why autopilot stops working kind of like somewhere in this range, and what changes when your savings start working with CPP, OAS, and the RIF rules instead of against them. Let's get right into it. By the way, if we haven't ever met, I'm Steve Willems. I'm a wealth advisor with the Willems Wealth Planning Group out here in BC. On this channel, we help Canadians plan smarter retirements, reduce taxes, and make better decisions in the years that matter most. So one of the most common questions I get, both from clients and from people that I meet with here on the channel, it kind of sounds something like this. They'll say, okay, but what actually changes, when you hit this number? And that number kind of moves around. Just this week alone, I spoke with people across a huge range. Some people had $1.5 million saved. Some had a little bit over 2, some north of $3 million. And the largest RSP balance I saw this week was just over $6 million. Like, these people are out there, they're watching this channel, they're living in the wild. And what's interesting is that regardless of whether someone has $2 million or $6 million, they often actually have the same question. They'll say, at what point does retirement actually feel different? Some people assume there's like a clear threshold, right? Like that once you cross a certain number, the math changes, or maybe the stress disappears. Like everything just works out for itself. Like I don't need to do anything. But in Canadian retirement planning, that's just not how it plays out. Because once registered accounts become a large part of the picture, right? Like RSPs turning into RIFs, CPP, and OAS kind of layering in, retirement stops being about how much you've saved, and it starts being about how that money is going to be forced to come out. And so that's why I do want to narrow this conversation into a very specific range today, right? Between $2 million versus $3 million. On paper, that extra $1 million, like it looks pretty massive, right? 50% bigger. And don't get me wrong, it absolutely helps. You will end up better off with $3 million than $2 million. But what surprises a lot of people is where that difference actually shows up and where it doesn't show up. So what we're going to do in this video is to walk through a real Canadian retirement case study using the same couple, the same lifestyle, the same assumptions, and simply change 2 things. We're going to change the starting portfolio size, and then we're going to change the order in which their money is drawn out of this plan. And as we do this, I'm going to be flipping back and forth in our financial planning tools, just so you can see exactly what I'm seeing. Now, the goal here isn't to prove that like $2 million is enough, or that $3 million is too much or not enough. The goal here is to show you this. Like at some point between $2 million and $3 million, autopilot seems to stop working, right? Like you can still win and yet quietly pay hundreds of thousands of bucks more tax than necessary. You can trigger OAS clawbacks that you didn't expect, and even die with a large, fully taxable registered account balance simply because no one ever told your money how it was supposed to behave. So before we talk about whether $3 million is better than $2 million, let's get very clear on who we're talking about and what the plan actually looks like. So let me introduce you to Jim and Jane Johnson. They're both 60 years old. They both retired at the end of last year, so they've just entered into this early retirement phase where their employment income is gone, but the government benefits haven't yet started yet. That is a very common Canadian setup. Here are the assumptions that stay exactly the same across every version of this case study. Jim and Jane are married. They're the same age. They own their home outright. It's worth about $1 million, and they want to age in place. They don't want to ever have to sell their place. They want to have $10,000 per month of income coming in, of after-tax, like spendable income, indexed for inflation the rest of their lives. So in this case, we're going to ignore kind of the retirement spending smile here Like, I'm just going to show them a flat, steady lifestyle assumption. Both of them expect to collect about 80% of their CPP entitlements starting at the age of 65. They're going to collect full OAS when they're both eligible as well. So no heroic assumptions here, no luxury lifestyle, no aggressive spending ramps. This is a pretty kind of normal retirement for a couple that saved well. Now let's define the two starting points we're going to compare. So in this first version of the plan, Jim and Jane have $2 million of investable assets, kind of structured like this. So we'll have $1 million in Jim's RSP. We'll have $500,000 in a spousal RSP in Jane's name. We're going to have $300,000 in combined TFSAs between the two of them, and then $200,000 in a joint non-registered account with a small amount of capital gains in there. Then in the second version, I'm going to simply increase the registered accounts. I'm going to grow Jim's RSP from $1 million to $1.5 million. I'm going to grow Jane's spousal RSP from $500,000 to $1 million. The TFSAs and non-registered accounts, I'm not going to touch those. We're going to keep those exactly the same. Nothing else changes. No lifestyle upgrade, no spending creep, no different investment assumptions, no testing CPP timing decisions. Just $1 million more concentrated into registered accounts, and that concentration is going to matter. So what happens next almost entirely depends on how income is drawn, not how much money exists. So now that we've met Jim and Jane, we've set the baseline, let's actually stress test this $2 million plan. If I pull this up here in the software, and we just kind of let the plan run the way most people intuitively do, here's what happens. In this first version, Jim and Jane are going to do what most Canadians do without thinking too hard about it, right? They're going to start with spending down their non-registered accounts first. Once those are depleted, they're then going to draw down their TFSAs. And once those are depleted, they're going to draw down their RSPs later once those other buckets have been emptied out. This feels often pretty conservative. It feels tax efficient. On the surface, it might even look smart, right? If we look over here at the results, the plan does work, right? They meet their $10,000 per month after tax spending goal. They're never running out of money for their day-to-day retirement expenses. They only hit a technical liquidity shortfall all the way out here at the age of 95. And even then, it's important to be honest about what this actually means. So at the age of 95, they still own their home. It's going to be worth about $2.1 million. And so in real life, that's what most people will do, right? They'll sell their home, they'll downsize, they'll use the proceeds to fund their care, can unlock that equity. So from a pure, do we have enough perspective, this first version passes. But look at what else shows up when we zoom out. If you take a look at this tax chart through their early 60s, we see a 5-year stretch of essentially no tax payable. That's like the classic tax planning valley that I often talk about. It looks great, but the trade-off is subtle. Because by deferring their RSP withdrawals, the registered accounts stay larger, which means that withdrawals are going to get bigger and steeper, and we're going to start them right around here at the age of 66. So again, nothing breaks, but nothing's really optimized, right? We're not solving for a particular outcome. So let's not change the people, the investments, the CPP, or the spending. Let's only change one thing in version B. Now, if I flip this one switch in the model and simply change the order of the withdrawals, here's what we're going to do. We're going to instead start withdrawing from their RSPs first. Then we're going to move down to their non-registered account once the RSPs are emptied. And then we're going to leave the TFSAs for the very end if we still need them. That's it. Again, no CPP optimization, no fancy strategies, no change to lifestyle. Same money, same plan, just different sequencing. And when we compare these two versions side by side, here is where the difference shows up. By age 90, their total personal taxes paid under this new version of the plan is going to be $241,000 lower. Their financial assets on the balance sheet are going to be about $429,000 higher, which means that their after-tax estate is going to be improved by about $249,000. And importantly, in this scenario, we're not seeing any OAS clawback. Cash flow remains smooth. There's no stress points that appear earlier in their retirement. Now, this 6-figure outcome difference was created by just one single decision and nothing else. If Jim and Jane wanted to take this a step further and kind of push this to the extreme, the math tells us that they could increase their inflation-adjusted spending up to by about $122,000 after tax per year and still be left at age 95 with the value of their home. Again, I'm not recommending they do that, but it tells you how much slack was hiding in this version of the plan. So let's pause here because this does matter. With $2 million, both versions of these plans work. Neither version causes panic, but one does quietly leave hundreds of thousands of dollars on the table. And again, we haven't touched CPP timing yet. This is the key takeaway before we move on, right? At $2 million, sequencing already matters, but the consequences here are still manageable, right? Now the question becomes, what happens if we take this exact same setup and we add $1 more million and we concentrate that into their registered accounts? That's where we're going to see things start to change. But first, hey, if you're watching this and you're thinking like, oh, shoot, it sounds like me. You don't need to figure this out on your own. I'll put a link in the description below if you want to have us double check whether your sequencing actually fits your situation before these decisions get harder to unwind. Okay, so if we jump back into that software and we adjust the inputs, here's what we're going to do. I'm going to increase Jim's RSP. It's going to go from $1 million to $1.5 million. Jane's spousal RSP is going to go from $500,000 to $1 million. The TFSAs are going to stay the same. We'll keep those at $300K combined. And the non-registered assets are going to stay at $200,000. Again, everything else is going to stay the same. So it's going to take us from $2 million to $3 million of invested assets, with the additional million sitting almost kind of entirely inside registered plans. So now let's run the exact same default withdrawal behavior that we just looked at. So starting with the non-registered account, then the TFSA, then the RSP is kind of pushed out as long as possible. Again, on the surface, nothing looks broken. If you're asking, do they have enough? Well, yes, of course they do. They had enough when they had $2 million. It meets their spending. They don't run out of money. There is no panic on the chart. There's no surprise there. But when we compare this $3 million plan side by side with that $2 million plan, the differences start to show up clearly. Let's just zoom in on the comparison. So at the age of 90, the $3 million version with poor sequencing shows $636,000 more taxes paid. It's going to show $127,000 of OAS clawback that did not exist in that $2 million case. And critically, they're still sitting on $1.6 million inside registered accounts at their age 95. I forgive you if that last number kind of makes you feel a little pukey, because if Jim and Jane were to pass away a couple years earlier at the age of 90 in this scenario, they'd still be carrying a roughly $2.7 million balance in their taxable registered accounts into their estate. That's not like a planning win. That's a deferred tax bomb. So if we pause here for a sec, they saved that extra $1 million. They invested well. They did everything right kind of by those conventional standards. And yet they paid dramatically more tax during their life. Those higher balances pushed out more income, which triggered OAS clawback that they didn't need to. They missed out on spending that money, right? On converting those dollars into memories and experiences. And they still die with a massive registered balance that's exposed to tax. And that's the uncomfortable truth that most people don't expect, right? Is at this level, you just can't autopilot these decisions anymore. The same safe sequencing that was merely inefficient at $2 million becomes actively destructive here at $3 million. Not because the money is bad, but because it's just in the wrong place and it's ignored for too long. And that's where a lot of people get tripped up. They assume that, if their plan works at $2 million, it'll work even better at $3 million. But that's just not how the Canadian retirement math works. Once registered balances get large enough, doing nothing is no longer neutral. It's a choice, and it's often the wrong one. This isn't a condemnation for having $3 million. It's a condemnation for treating $3 million like it's still $2 million. So let's do the same thing we did earlier. Let's keep the people, the assets, and the spending exactly the same. And let's again change the sequencing in this $3 million scenario. So again, instead of kind of the default behavior, right, spending non-registered first, then TFSA, then RSPs, we're going to reverse that sequence. We're going to first draw from the registered accounts, then the non-registered accounts if we need to. And then at the very end, we'll pull on the TFSA balance as the last bucket that we ever touch. That's going to be our only change. And if I flip back over here to the comparison view in the software and kind of line by line, these two $3 million scenarios side by side, the difference that we see is immediate. At the age of 90, the OAS clawback issue that showed up in the first $3 million scenario, it's entirely gone now. The total personal tax paid is $177,000 lower. And because more registered money has been intentionally drawn out earlier, the estate tax bill is also reduced by about $457,000. If you put that differently, this single sequencing change again improves the after-tax estate value by roughly $801,000. That is not a rounding error, and that's not due to market performance nor luck. That's just using the tax system deliberately instead of letting it run on autopilot. And here's another insight that kind of tends to surprise people. If Jim and Jane actually wanted to spend more, if they wanted to lean into lifestyle rather than preservation, this improved sequencing gives them more room to do that. So in this version of the plan, they could increase their inflation-adjusted spending from $120,000 a year all the way up to $155,760 for the rest of their lives, and still have that last liquid check bounce right around age 95 with the house remaining as the backstop. Same net worth, same investment, same return assumptions. The only difference is that now the taxes are lower, the OAS clawbacks are avoided, those registered balances are intentionally reduced, and the plan produces either more lifestyle or a far better estate outcome. Now, this draft is by no means perfect yet, of course, right? There's a ton of stuff that we haven't tested for the purposes of this short little video. More things to work through. But the key point I want you to see is this. At $3 million, the question is no longer do we have enough? You already know the answer to that. The real question becomes, are we letting the structure of our money work for us or work against us? Because at this level, doing nothing isn't conservative, it's actually expensive. But here's the mistake I see people make when they cross a a number or a threshold like this, right? They'll assume that more money means less need to pay attention. And in reality, the opposite is often true. If retirement planning came with a service manual, right, like your car does, this would be one of those bolded pages that says from this point forward, autopilot is no longer recommended. Cars are easy. They're standardized, the same engine, the same service intervals, same warning lights. Retirement is not like that. Everyone has different specs, right? Different account types, different CPP and OAS timing, different tax exposures, different estate goals. But if there were a retirement service manual, this is what it would say around $2 to $3 million, right? You now have enough that sequencing matters more than saving. You now have enough that taxes, not market, will do most of the damage. And you now have enough that doing nothing quietly creates future problems. And that's the real difference between $2 million and $3 million. At $2 million, you can still get away with some of this inefficiency, right? Bad sequencing hurts, but it's not necessarily catastrophic. And the margin for error is actually a little bit wider. At $3 million, the same bad habits, they get magnified. Your registered account balances, they're going to grow into forced withdrawal problems. Your OAS clawbacks often show up perhaps unexpectedly, and these estate taxes can become very, very real very fast. And there's this important point that we saw in both of these cases, right? At a certain point, somewhere between $2 and $3 million for many Canadians, you stop naturally needing to draw from your TFSAs and your non-registered accounts at all. Even with improved sequencing, Jim and Jane, they never needed to actually touch their TFSA and their non-registered account, which means if you're not intentional, you don't run out of money, you die with money in the wrong place. And that's a trap. Not because you didn't save enough, but because you didn't change how decisions get made once saving is no longer the hard part. So the takeaway here isn't $2 million is better than $3 million or, more money creates worse outcomes. I'm not saying that. That's not true. The real takeaway is this. Crossing a number doesn't solve these planning problems. It just exposes them in new ways. So when people ask, what actually changes between $2 and $3 million in retirement, the answer isn't lifestyle, and it's not peace of mind either. What changes is the cost of being on autopilot. At $2 million, inefficient sequencing is survivable. At $3 million, the same behavior quietly creates six-figure tax problems, OAS clawback, and a large estate bill that won't show up until much later. This case wasn't about proving that one number is enough and the other isn't. It was about showing that once you cross a certain level of wealth, planning decisions start to matter more than saving decisions. Right? Markets did their job for Jim and Jane. The difference in outcomes came entirely from how that income was structured, when that registered money was drawn out, and whether the plan was intentional or reactive. And that's the real risk for Canadians in this range, right? Not necessarily running out of money, but leaving it in the wrong place for too long at the highest possible tax cost. So if you're sitting somewhere in this like $2 to $3 million range and wondering what actually changes now, the answer is simple. You just can't let the system make these decisions for you anymore. And hey, if you want a second set of eyes on how your accounts are positioned, not just like whether you have enough, but whether your money is working with the rules or against them, I'll put a link in the description below if you want to book a call. We'll walk through your situation, kind of stress test the plan before some of those decisions get locked in. So hey, thanks for watching. I hope this helped kind of clarify what really changes as you pass through these different thresholds and why good planning matters more, actually, not less, the further out you get. Hope that helps. I'll see you in the next one.